Registrations are now open for our ACCA Performance Management exam course. Get access to our comprehensive playlist of over 46 hours of content, including concept videos covering the entire syllabus, exam videos explaining how those concepts are tested in the exam, and question videos to help you with exam practice. Subscribe to one of our packages. The smallest package, for $10, you get access to the entire course for 7 days, or you can subscribe to one of our longer term packages. For more information, check out the links in the description below. And now, on to the video. Hello everyone, and how are you all doing today? So, we're going to be doing another ACCA Performance Management question today. And the question we're going to be doing is from the June 2014 past paper. So back then apparently they didn't have sections, so these questions are all written questions for 20 marks, which is good because they're similar to the current format where section C questions are all for 20 marks. Of course, we're not going to be doing in writing, we're going to be doing them on the computer in an Excel spreadsheet to mimic the computer-based exam, okay? And this question, the good thing about it is, it's one of the few past paper questions that ACC has released that is a section C type question for decision making under risk and uncertainty. Basically your payoff tables, maxi max, maxi min, that sort of stuff. And they very rarely release such questions in their past papers, even though in recent sittings, from what I understand, they have been testing this a bit, where you have to make a payoff table and make decisions then based on that payoff table. So for that practice, we're going to be doing this question, okay? So let's get into the question then. As always, we start with the requirement. So requirement part A, calculate each of the 6 possible profit outcomes which could arise from GAMCO in the coming year. So different profit outcomes basically means your payoff table, okay? So let's just start by labeling our question. This is question 4 and this is part A. Be sure to make these things bold, italic, underline, something to distinguish them from the rest of the answer, and keep a separate column for them just for a good presentation, right? Okay, so let's go through the question. It's a very short case scenario, thankfully. GAMCO sells electronic equipment and is about to launch a new product onto the market. It needs to prepare a budget for the coming year and is trying to decide whether to launch a product at a price of $30 or $35 per unit. Let's stop here. Keyword here, decide. Meaning, remember a payoff table, we have decisions and outcomes. So if we have the word decide, that means the price is part of the decision. So we have 2 decisions. Either we can price the product at $30 or $35, okay? So we have our decisions, now we're going to look for the outcomes. The following information has been obtained from market research. So for each price, we've been given different sales volume with probabilities. And what did we say about probability? Probability has to do with outcomes, right? Whenever you see probabilities, then they're talking about the outcomes. So the decisions are the price per unit and the corresponding outcomes are the sales volume level, right? What is interesting here is, unlike most payoff tables where all of the outcomes have a similar probability, these 2 decisions have 2 different sets of outcomes with different sets of probabilities, okay? So effectively, we'll need to make 2 payoff tables and then make collective decisions based on those payoff tables, okay? So that's a little twist here. And then they've given us a notes, which is information on how we're gonna make our payoff table. So variable cost would be $12 for production volumes up to and including 100 units, okay, each year. However, if the production exceeds 100 units, the variable cost would fall to $11, okay. So up to or including 100 units, so these 294,000 level, the variable cost would be $12. For the remaining, where it's exceeding 100 units, it'll be $11 per unit. Advertising cost would be $900,000 per annum for a selling price of $30 and $970,000 per annum for a price of $35. And fixed production cost would be $450,000 per annum. Okay, so let's prepare our payoff table. So in our payoff table, we'll include the probabilities as well, just because they've given us the probabilities here. So probability, the decision is price at $30. Let's make that payoff table first. Okay, since these are headings, let's bold, underline, that sort of stuff. Let's stretch them out a bit, and let's make these centralized so that it's presentable. Okay, and we have our outcomes, which are, let's just mention that outcomes. We should copy this here. Yeah. Okay, so now we have our complete payoff table outcomes. So the outcomes for $30 sales volume can be 120,000, 110,000, and 140,000. Okay, so 120,000 units, 110,000 units, and 140,000 units. Okay, the probabilities are 0.4, 0.5, and 0.1. Right? Okay, so the first one, we need to calculate the profit at each. Now the profit when the sales volume is 120,000. So we'll take the price of 30 into 120,000. That's why we put the number there, so we could use it for a formula. Minus, first we have the variable cost. So variable cost, what did this say? If production exceeds 100,000 units each year, then the variable cost would fall to $11 per unit. So this will be 11 into 120,000. Alternatively, we could say 30 minus 11 into B4, which is fine as well. Minus advertisement cost for a price of $30 is 900,000. Okay, so 900,000, and minus fixed cost would be 450,000. Okay. Now technically you could do these calculations separately and then put them in the table. It's up to you. There's no fixed way of doing this. I think since the examiner is going to look at the formulas anyway, I would think you might as well make it simple and sweet, right? So that's fine. That's our first formula. Okay. Now, the second one, let's just copy this down and let's amend it as need be. So if we go to this formula, 30 is still the price into 110,000 units, which is fine. Variable cost 11 is for 100 units exceeding 100,000, which they are in this case, so that's fine too. Advertisement cost will remain the same at 900,000 because the price is 30, and fixed cost will remain the same at 450,000. So we're done. So that's very quick, and then copy and paste again, and let's just double check the assumptions. 140,000 units, again 30 price, which is fine. Variable cost will be 11 because it exceeds 100,000 units, and the advertisement and fixed cost will remain the same. So there's our payoff table for the $30 price decision. Okay, so let's just make it accounting based format, reduce the decimals, and here we go. Okay, now the other table we have is for a price of $35. Okay, so let's just copy our format down here. Outcomes will now be 108,000, 100,000, and 94,000. Okay, probabilities will now be 0.3, 0.3, and 0.4. Okay, so let's calculate our profits, and the price will now be at $35. Okay, so the first thing from the get-go, let's just amend the formulas here. The price will now be 35 instead of 30, right? After that, production, has it exceeded 100,000 units? Yes, it has. So the variable cost will remain at 11, and the advertisement cost will now be 970,000 rather than 900,000 for a price of 35, right? Like they mentioned over here. Fixed cost, however, will remain the same at 450,000. So again, there's not much we needed to edit, but we'll copy this formula down below as it's more relevant to this table. Okay. Second, the price will remain at 35 and into 100,000 units, but the variable cost, okay, now this is interesting. So it says variable cost will be $12 per unit up to and including 100,000 units. So now instead of 11, we'll need to make this 12. Advertisement cost will remain at 970,000 and fixed cost will remain at 450,000. Let's copy and paste this formula below. Last one, 35 into 94,000 is fine. Variable cost, again, it's less than 100,000 units, so it will remain at 12, and advertisement and fixed cost will remain the same. So there we have it. There's our payoff tables. And obviously, if you look at it, it's an 8-mark question. Technically, you would have 1.8 minutes per mark, around 15 minutes to do this part. And in a paper-based exam, obviously you would have to do all these calculations manually, but see how the computer helps. Everything is so simple. We copy and paste the formula, make our tweaks, and we're done. So we saved a lot of time on the computer for this part. Okay, so we have our payoff table. Now we can move on to part B. Okay. Part B says calculate the expected value of profit for each of the two price options and recommend on this basis which option GAMCO would choose. So expected value, for recap purposes, which risk attitude did it relate to? Risk neutral people, right? And expected value is the only calculation for the payoff table which uses the probability. So aren't you glad we included the probability up there? Okay. So for 3 marks, we just need to find the expected value for each of the price options and recommend on that basis which option GAMCO would choose. So then we need to make the decision as well. So now we can simply copy our hard work from above down below, and now we can find the expected value. So let's make a small calculation. Okay, so expected value is based on the, let's put this here, probability into your payoffs at each outcome level. So it'll be 0.4 in this case times 930,000 plus 0.5 in this case times 740,000 plus 0.1 in this case times 1310000, right? Okay, and then once again we can make use of the spreadsheet and copy the formula directly so that it does everything for us, and we have our two final expected values, right? Okay, and the higher expected value goes for the second decision. So the decision is based on expected value would be to price at $35, since that makes the higher expected value. Okay, so let's carry on with part C then. So part C, we now have the requirement, briefly explain the maxi-min decision rule. Okay, we need to explain what it is. So whenever the requirement break down the requirement, right? Because students often don't do that and they miss out on answering certain parts of the requirement which the examiner keeps stressing on, right? So break it down. That's one part. We need to explain the maxi-min decision rule, what it is, and then identify which price should be chosen by management if they use this rule to decide which price should be charged. So 2 parts for these 3 marks. First part, explain the maxi-min decision rule, which is for the risk-averse attitude. The maxi-min decision rule is used by people with a risk-averse attitude. Basically, they want to avoid losses as much as possible. Hence, they are concerned with the decision which can give them the best payoff from the worst possible outcomes, right? Best of the worst. Okay, so there's our explanation, and now we make our decision. So maxi-min, how do we make the decision? Remember in our videos, maxi-min, break it down into 2 parts. First, start with the seconds level, minimum. At each decision level, pick the minimum. Okay, so the minimum payoff for $30 is going to be minimum let's just write it down, right? At the outcome of, so where are we going to get the minimum payoff for $30? It's going to be 740,000 at the outcome of 110,000. So it's going to be is 740,000 at the outcome of 110,000 units, right? and then let's just copy this down so that we can follow the format. Minimum payoff for $35 is $742,000, so slightly better, at an outcome of 94,000 units. Okay, the better payoff is at the price of $35, right? Hence, under Maxi, our decision would be to price at $35, right? Simple, straightforward. Okay, so we're done there as well. 8, 3 and 3 marks, 14 marks already down, and we're left with the last part, part D. Discuss the factors which may give rise to uncertainty when setting budgets. So part D. Okay, now this is one of those questions where they want you to do some general analysis, right? If you can bring in certain concepts if you want, but technically this is general analysis. What may give rise to uncertainty when setting budgets? So you need to apply your general understanding of finance, business, etc. in order to be able to do this analysis. And my tip to you guys would be, do it with confidence, right? The difference between a good analysis and a bad analysis from my own experience is simply confidence. If you're confident in what you say and you justify it, your analysis will be good, right? And if you're not confident that you can do the analysis, you're not gonna do it well. Okay, it's as simple as that, honestly. So let's think about this, right? Which factors may give rise to uncertainty when setting budgets? If you're setting a budget, think of yourself as a manager in a company. What things will you be concerned about when setting the budget? What could cause uncertainty? Generally, uncertainty has less to do with your own internal operations, though there could be some uncertainty there, and more to do with the external environment. So talk about the different external things that could happen that could give uncertainty to a budget, right? You could use the Pestel analysis, like politics, economics, social, technology, environmental, legal things can change, right? And build your analysis based on that, or something along those lines. Or just talk about the different stakeholders, customers, suppliers, the government, right? What differences they could cause in the external environment. It's for 6 marks, so let's make 6 points, right? Let's start with an easy one, the customers. So let's just give an introduction. Factors which may give rise to uncertainty when setting budgets. Setting budgets include, and honestly there's a wide scope, so you could make a lot of potential points. We're gonna stick to 6 points. So first we could say is customers. Customers can change their preferences and switch to alternatives for our product. This can make it difficult to predict demand accurately, leading to uncertainty, right? Uncertainty of the sales we need to make, and the units we need to produce, right? No need to go overboard with writing long paragraphs. Just make it relatively short and sweet. Don't make it too short that it's literally a sentence of a few words. Don't make it too long. Just something small that is easy to read and manageable, right? This seems fine. And use spacing and lines between points to make it easy to read, right? If you put a whole blob of paragraph text together, no one wants to read it, right? Including the marker. He'll be forced to read it, but he doesn't want to read it. And he'll like you a lot more if you make it easy for him to read, and he'll be more inclined to give you marks. So keep that in mind. Okay. Part 2, number 2, customers. Let's just continue with that theme. Suppliers, right? So people we're selling to, now people we're buying from. Suppliers can change their prices or supplies or quality, which will impact our costs, right? This will make it difficult to predict our costs and cost behavior accurately, causing uncertainty regarding our profit margins, right? So we're using the buzzword over and over again, tying each point to the uncertainty, just to really drill home the point that we know what the requirement is and we're addressing it. Okay, be obvious about it. So point 3, we've talked about customers, we've talked about suppliers. What are the stakeholders? The government, right? Let's talk about the government policies, right? The government can change its policies, which might impact inflation and tax rates. These in turn will impact our prices and expenses, leading to uncertainty when budgeting for these. Okay, number 4. So government policies, what else things in the external environment can happen? Okay, we can talk now a bit from a pastel point of view. Technology, right? Changes in technology. Changes, these can impact the feasibility and profitability of our products. And as well as impact the nature of our operations. These are difficult to predict and can have a major impact, making them a large source of uncertainty, right? We didn't talk about one more stakeholder, competitors, right? Let's talk about competitors. Behavior of competitors. Competitors might launch a new product, grow, or even go out of business. All these things will impact our demand and profits. These might be difficult to track and predict, making it a source of uncertainty. Okay, last point and we're done. Point number 6. So we've talked about technology, we've talked about government policies, customers, suppliers, behavior of competitors. What other sources of uncertainty that can we have? Right, we can have social changes, which are quite relevant in this day and age, right, with the whole pandemic. So social changes, major changes in society impact individuals as well as businesses. There are many possible consequences of changes in society which are very difficult to predict. Now we've been very generic, so let's be a bit more specific in the point, whether it be changes in consumer preferences or the way businesses are viewed. These can all make things uncertain. Okay, So we have our 6 points here. So we talked about customers, we talked about suppliers, we talked about government policy, changes in technology behavior of compared to social changes. Now you could see that, for example, in customers we talked about preferences as well, and in social changes we talked about preferences as well. So if we didn't add the point of the way businesses are viewed, we should have added some more points there, just to distinguish the point from each other. And this is a tricky thing because when you're writing long analysis, it's very easy to start repeating points. So if the point was too similar, we should have changed it, provided we had time to go through things. Okay, so we're done with the question, and as you saw, it's pretty easy once you use the computer to do the calculations and the for the payoff table and expected value, etc. Okay, so I hope you guys benefited from this, and I'll see you guys next time.